I request Shilpa to give the brief introduction and to start the session.
Good morning, everyone. It's my privilege to introduce today's speaker. Mr. Anurag Singal is a CA rank holder and holds an MBA from IIM Ahmedabad. He has 15 years of corporate experience and his ventures are cajobportal.com and Betafin Partners. He has expertise in financial modeling, valuation and analysis, investment, pitch decks, competition landscaping, and business plans. Over to you, Mr. Anurag. We are eager to hear you today.
Hello, Ms. Shilpa. Thank you so much for your kind words. Yeah, good morning, everyone. And thanks everyone for turning up on a Saturday morning. I think it's quite cold out here in Calcutta. Relatively not so much. So I will like to start off with one valuation paradigm, which is
Vijay, can you stop share screen?
Yeah. I'll start mine. Okay. Okay. So I like to start off with one very clear valuation paradigm that we have at the forefront of our communication is that Paytm brought a IPO last year at 2150. The stock price had tanked to 539. And yesterday it moved up like this was like 6.5%, 7% upwards. So there is a 75% destruction in wealth. So there are two people who valued this stock. One who has valued this at 2150, the merchant banker, the IPO advisor, and someone who's ensured that there is full subscription. So the public at large has subscribed to this. There's a market force which brings this stock price to 539 today. And then there is also someone who is going to tender this share at, let's say, 700, 800. They are going to have their board meeting on the 13th. So in the board meeting, they're going to come up with a buyback price. So this probably Paytm is like public at your total mercy. What would be your thoughts around these valuation paradigms in terms of the 2150 valuation, the one who brings it down to 539, and then right now, there'll be someone who will tender that in buyback. So as a valuation professional, what is your view around this entire valuation? Yes, anyone. And I would like this to be a participative session so that, yeah, you all can unmute and speak. That is fine. So that will make it all the more interactive. So Mr. Sanjay Murarka says that there was overpricing. But then,
yes, sir.
Yeah. But so typically buybacks are, we've seen buybacks by very profit-making companies like Infosys and Wipro, TCS. Now here is this company which has never earned a rupee of profit. So again, the larger question there becomes, if you look at the performance of Paytm, okay, so how much loss has Paytm booked in FY23, FY22? Somewhere around 2200, 2300 crores. Then we also have 2 quarters, Q1 and Q2, where they have brought in 600 crores of losses in each period. Now, why is that this valuation of even 539 justified then? So because our question is that, these are the challenges that emerge in the valuation of finance professional of unlisted listed securities. So from that perspective, what really will bring the valuation of Paytm at 539 today? Because the company has been loss making 2300 crores of loss last year. And again, this year, it is at 600 crores of loss in each of the quarters. Then what really justifies the valuation of Paytm? Yes, anyone?
It's plans,
It's a
business plans, business plans.
business plans as in
Business model.
The expansions.
but if a company which is loss making expands, will the losses also not expand? If the strategy of profitability is not there, then how will that happen?
They're selling the business model on the future prospects of the company.
Future prospects of the company. That's a very interesting thing. So when you talk about contemporary issues in valuation of securities, one larger question that emerges is that it is about the future value of the business that they really kind of factor in, right? So, so then how do you value such kind of securities which are currently loss making? So most of the work that comes in the startup ecosystem where you do valuation is that the company is currently in losses. So then how do you really value the company in that case? So I do a lot of valuation for unlisted securities where the company has raised a fund and then just a minute, I just So a lot of valuation that we do of unlisted securities, all of the loss is there. Now tomorrow will the regulator and we project that there is a profit in the future, because of which we then take a reason to believe that yeah, this entity is valued at. So yesterday I did the valuation of a company in the edtech space where the company had registered 2 crore losses in this first half of the year, and then again losses in the next year, and then the next year again forecast, and in the terminal value they are forecasting that there'll be profit. So in that perspective, then how do you really as a valuer take cognizance of the fact that okay, this company is going to make profits? So when you're certifying that valuation is, let's say, 6 crores of a loss making company, so are there any challenges in that? Are there any risk in that whole process? That is one question that I want to ask you.
Sir, the risk is like anyhow, we will give the disclaimer or assumptions. We will give saying that, okay, the future projections are not in the value or whatever it is, okay, as per that management representation, and we have discounted those values.
Okay. But then is there no risk that you are just relying on the basis of a management representation? Tomorrow, can the regulator not come and tell you that what was the basis for you to rely on the management representation? I mean, this whole game of, giving an MRL is the easiest thing that happens in practice today. That
Yes.
what do you want as a valuation? I am happy to do an arithmetical exercise. Hello? Yeah, so
Yes, sir,
I'm
we are able to hear.
So I am happy to do a valuation exercise and give this valuation. This valuation is 48 crores at 6458 per share for the purpose of this. But then tomorrow, can the regulator not come and see that then what was the role that you did? So is the role that we as registered valuers are performing is just an arithmetic exercise? So that is one question that I want to ask this particular house.
Yes, it is arithmetical calculation only. Even it is, as everybody knows, it is a subjective matter. Even when there are transfer of shares, okay, even the purchaser wants, okay, for lesser price, seller wants for more price. That is
Yes.
Obviously. Even we have operation mismanagement cases. Even I have given one valuation report where 400 crores, they went to NCLT now on this valuation only. It is obviously. There will be like, okay, the more price or less price, the debate will be there always in the valuation.
Yeah. So what I'm saying is, for example, in Paytm in FY22, it was 2,300 crores of loss. H1 of FY23, they have done 1,200 crores of loss. And now you'll go to a registered valuer and give the justification for this particular market cap. So most of us will not get, let's say, the cases of as large as Paytm, but yeah, Paytm and all will go to even a big four. So big four stamp, the moment the big four stamp comes, then it becomes like baptism by fire. So the moment a big four stamps on that valuation, and we'll come to that. That is one of the issues that I want to raise today. So, are we just really performing an arithmetical exercise depending on who appoints us?
Sir, one thing you are talking about Paytm case, okay, the valuation, they won't rely on registered valuer or valuation report. It is all on road shows, and QIBs will determine the price.
Correct, it's a listed company. You are right from
Listed
that
company,
perspective.
yes.
But
Yes.
similarly, there is a Byju's, and I
Hmm.
had published an article recently in Hindu Business Line about, and I'll come to that Byju's case, where in every 3 months, they are changing the numbers that they are giving as projections in their management representation. And that is quite an interesting exercise. And we'll come to that. So the first thing is that as valuers, so when you're talking about contemporary issues in valuation of securities and intangibles, is this just an arithmetical exercise where you have the liberty to rely on an MRL? So whatever is the management now says, okay, 2,300 crores loss, 1,200 crores loss, but yes, FY24 life will become happy and we will do 200 crores of profit, and FY25 we will do 500 crores of profit, and therefore this you take a terminal value and you arrive at a particular valuation. So I sometimes feel very scared when I do this. I will write as caveat that this is on the basis of management representation, etc. But there have been income tax cases where the department has questioned the valuer's role in that entire exercise then. Because what the department says is that this company is saying that this valuation is on the basis of independent assessment by a registered valuer. Okay. And the registered valuer says that I relied on the company. So the company puts the ball in the valuer's court. And the valuer says, so they say that he's an independent valuer and hence the share price has come as this. And I will show you that department's case there. And the valuer says that, boss, I have simply relied on the management representation letter. Then where is that independence? You have just done an arithmetical exercise of discounting all the numbers to today's value at a particular WAC and saying that I, as a registered valuer, have relied on the management representation and come to this particular value. Are there any risk associated with this? In fact, this is one question that I sometimes ask myself also, and I would like to ask this August House, that is there any risk that you are performing here? Because tomorrow will a regulator come and tell us that, okay, what have you done? Is it just an arithmetical exercise for which the Companies Act has appointed you? So that is one question that you have. And then if you have a resistance, there is another repercussion of that. Yes, anyone?
If DCF method is relied upon,
Yes.
and if the projections of past performance is an indicator of future performance, then we can justify our role.
Past performance is indicative of future performance.
Yes, if we believe that, let's say, if the past performance is reliable, or if it is progressive, or
there is no past performance. It has always been loss making.
that is right. But how the sales are improving, or how the margins are improving?
Yeah. So the more the sales is improving, the more losses are happening, and sometimes the cash burn is further increasing. In
No,
that case,
right.
what do you do?
But fixed cost may not be increasing the same like the what we call the variable costs in future. They'll be
So you
mostly
will have to
constant.
do all of that validation. So that is one question that you've rightly pointed out. That
And
you
moreover,
have
if
to
the
do.
profit margins are increasing, say by way of other revenues or supplementary revenues or other sources, then we can rely upon. And if the profit margins are likely to increase or at least constant, then probably we can rely upon the past performance.
Okay. So past performance you are saying is an important thing. So you will be in a liberty to do some validation. But most of the cases that I have seen of startups coming, the number is reverse engineered. And I'm sure you would have also told that, when the valuation exercise comes, they come and say that, boss, I want 6 crores ka 8 crores ka valuation on the 30th of September because the investor has already come and committed to funds at this level. I need your valuation report for MCA filing. Would you take up this kind of an assignment?
No, unless I'm convinced about the growth prospects, the state of the economy, or the industry in which the particular startup or any company operates in, then I cannot.
So normally you should not. But if you take a stance that you will not, so mostly what will happen is,
They will give to somebody else.
yes, they will give to someone else. So this is one major dilemma that we have when we talk about valuation of securities, that today in this kind of market, valuation as a service for PAS 5 filing has become completely as a commodity. How many of you will agree to this?
It's actually PAS3.
PAS 3 and PAS 5, PS 3 and in PS 3 and PS 5, all of that which happens together. How many of you would agree that this has become like a commodity business where you just need a registered valuer for stamping, and the conversation starts with whether you will take 15K, 20K, 25K. And in that case, will that become an issue in the value subsequently as a professional? Like, where is the future of this profession?
That's an absolute challenge. Actually, what happens is it's a call that a valuer has to take. The contra question to this is, imagine if there was no mandatory requirement of a registered valuers for this kind of a statutory purpose.
Yes.
Would have come to any of the valuers? No.
No.
So therefore, it will always be a service business is always like this. The question is whether, even though it's a service business, whether valuer would like to stick to his stand and commit, because today valuer is able to do it because liabilities are not seriously there on valuers. The moment we have serious liabilities on valuers, then it's going to be a difficult task, and you will not see this kind of a mere acceptance for a small price for giving valuations to all these companies.
Absolutely. So that is one major thing that you're very right. So right now there will be no liability. Now the department is not going to come and ask you. Let's say one of my friends, he got 5,000 rupees for signing a valuation certificate. And then the investor sued him in Jaipur court, and he had ended up spending 10 lakh rupees in fighting that case for a certificate for which he had in his initial days signed for just 5,000. Then he took professional indemnity. So now the investors are very happily suing registered valuers also. We've come across such cases also, that I relied upon your. So sometimes, so when it is about PAS 3 filing, sometimes cases come where the companies wants to raise funds, and it says that you give me a 40 crore valuation and you give me a certificate around that, so that when I talk in a meeting with the prospective investors, I can say that, okay, there is a registered valuer who has given that my valuation is 40 crores. In that case, what would be your view on that, taking this kind of an assignment? And
Kindly repeat that.
Huh?
Kindly repeat, please. Sorry.
Yeah. So I'm saying that what happens here is that there are a lot of companies nowadays. What is happening is I get some assignments and I say no to such assignment that the company is prospecting fundraise. Okay. And for that, it needs to talk to investors. And then for that purpose, they say, you give me a valuation certificate and you write that the company is prospecting for funds, and in our assessment there is a 40 crore valuation of this company. So I did it for a company which is from Northeast into organic, into lending for organic farming. So for prospective investors also, see, there are two risks. So as compared to someone who is already invested and you are doing a PAS 3 filing, in that case, the risk is still less because the transaction is already consummated and you just need an RV certificate for the filing. But there are instances where assignments are coming where prospective investors are seeking a valuation report. And you can also write that the company is seeking prospective investments and you give a valuation of 40 crores. In that case, is that a kind of an assignment that one would be comfortable taking?
So it's a very big task. Prior to accepting such a valuation, we should
Sorry.
exercise a due care. What is the prospect of the company? We know that just to get the fund, after that it is over. So that makes a big challenge to the RV also. So my perception is that we should have exercise with huge care. They may ask the other, are we ready to get on some so man, are we accepting or not? So okay, I principally I will not accept the same.
Yes, so Mr. Prakash says RV is not supposed to do any valuation which is mandate snatching and convenience valuation. Correct? Absolutely. But then what valuation work do you get? Because most of the work in the market is like that only. You don't for any, if you talk to large private equity firms, they also do a lot of valuation, but there they are obsessed with Big Four and then Duff and Phelps, which is now known as, I think, Kroll or something.
Yeah.
And RBSA and maybe a BDO like that. So everyone is obsessed. So a good private equity VC fund will always say that, oh boss, I just want Big Four or Duff and Phelps, BDO, RBSA, Kroll. And so an individual, only these kind of cases come. You set up a shop, you depend on it for your livelihood. So this profession also is, to my mind, to my limited understanding, also facing these kind of challenges. So this, and what would be your views on that? Then in that case, you set up a shop, you depend on your livelihood on such assignments. And the only assignments that you get are these: already invested, give me 40 crores. I want to raise, give me 40 crores as a valuation certificate. So then in that case, as a valuation professional, what value are you adding? So as someone rightly said, would the company have come to you had that not been a statutory compliance? No, because they don't really care about what you are doing. In that case, how do we add value? What are the issues here and how do we really caveat our role in such cases is one question that is very interesting and we could discuss here. How do we caveat everything so that at least we are on the right side of law? Because I think once we've set up a shop, we depend on our livelihood for this, for our livelihood on this, then it is very difficult for us to say no in many cases. Then what do we do? Unless,
I slightly disagree to that.
yeah.
See, are we saying that in every aspect? For example, what I'll just give an analogy to this, wherein saying that unless I give bribe to the local statutory municipal authorities and policemen, I cannot run a shop in a neighborhood, for example. Yeah, so those are the structural problem we accepted. But if that becomes a huge component in my running the business, I would not run the business.
Absolutely.
So
Correct.
similarly, if all my valuations are just only for acceptance merely, and that is my livelihood, then something is wrong with the valuer itself. I would say that acceptance should only be in such cases a minuscule percentage of the overall livelihood requirements. So in either you raise your bar, pick up, convince, and if you don't have all these things, probably you should move out from this livelihood option and go for some other livelihood option.
You're right. But if the industry per se, to my mind, is except the Big Four different Phelps, this whole nexus is a wrong word maybe, but merchant banker and RV both are doing this thing for every company that is raising funds. More or less, this whole story is the same, which gets repeated. And I work with clients across India. The same thing is happening. And raising the bar in terms of, so where do we actually add value? We add value in things like ESOP valuation. Okay. We add value in valuation of convertibles, because then it is not like a simple DCF, which anyone can do. So therefore, the challenge and the ask for us actually, if we depend on valuation as a shop, as a valuation, as a livelihood, is to graduate above this routine thing and get into places where client also depends on you to add value. For example, in valuation of ESOPs and I did a very interesting exercise where, and this is a very interesting thing when I'll ask, and I'll throw this to you. For example, the company has given it CCPS at rupees 1300 per share. You are doing an ESOP valuation. So in terms of equity value of the equity share, because in the Black-Scholes, the input will be the fair market value of the equity shares as on the date of the grant of the value of the ESOP. In that case, from CCPS to equity share, how will you arrive at that journey? So the level 1 input that we have is the recent round in which the company, let's say right now, we are in December. So let's say in June 22, the company has raised a round of CCPS at 1300 rupees per share. Now, during this entire Q1, Q2, Q3, as per the ESOP policy, what is happening is that there is a pattern in which people are getting grants. Okay, they will get vested 4 years from now, etc. So now in the Black-Scholes model, in this, the whole question is the spot price. You have a level 1 input, which is a CCPS. How do you from there come to the equity share value is the question. And what could be the good valuation practices for this is one question that I really loved. And I think these are the kind of problems. No, you're not able to hear my voice.
Uh,
I think we can hear. Carry on.
Yeah. So from this exercise, this is one challenging valuation assignment that I really enjoyed. That from CCPS, how do you really arrive at the implied equity value? So anyone has got a hang of, this is a very standard practice, because the client for which I was doing ESOP valuation had an auditor as a Big Four. They insisted out a specific methodology to arrive at the equity share value. You really cannot say that CCPS, what is the difference between CCPS and equity share?
they have an option of conversion or
Yeah, compulsory convertible.
yeah.
But why would a CCPS, which will be more valuable, CCPS or equity shares?
CCPS.
Why?
He's an option to exercise, no?
No, it's not an option. It is not OCPS. It is a compulsorily convertible preference share.
Till the time it is converted, it is a preference share which has a preference over the equity.
Yes. So in terms of distribution proceeds, if the company were to get it liquidated, they will have a preference over that. And then there are things like anti-dilution clause. What is anti-dilution clause? As compared to, so let's say in case of
Lock-in period?
hmm?
Is it lock-in period?
No, anti-dilution clause is not lock-in period.
The extent of equity stake they will get after conversion will not get diluted. At least they will be protected whenever they decide to convert.
Yes. So essentially what happens is that if there is a down round, so for example, they subscribe to CCPS at 2150. And in the next round, the company raised CCPS at 1200. So this is technically a down round.
So they will be eligible to take the benefit of this down round.
Yes. So they will be allotted such number of shares that their stake that they got at that point of time in the company when they raised funds, they invested at 2150 will be the same. So additional number of shares will be allotted to them pursuant to a particular down round.
This
So
was a
that's
serious issue at the time of COVID when people were not actually, like in this case 2150, they were not getting. They had to go for 1200, but then they had this anti-dilution clause. So they could
Yes.
never get new funding. COVID had badly hit, anti-dilution clause.
Yeah, so anti-dilution clause basically protects the investors, existing investors. And basically what you can do in that case is you can allot additional number of CCPS to them for free. So in that case, what happens is, let's say that they had invested they had got a 5% potential equity in your company at 2150. You allot additional number of shares such that that 5% stake potential equity remains the same. So that equity you will essentially have to give to them for free. So for that reason, CCPS is more valued than equity share because of preference in liquidation proceeds and anti-dilution clause, etc. So now, as part of the ESOP exercise, if I know that, let's say the CCPS of a particular share has been issued at 1300, so eventually they might get converted at 1:1. Or in some cases, you can simply apply an arbitrary discount that there will be a 15% discount between CCPS and equity share. Is that a fair argument that you can just say that, okay, because of the superior voting rights, superior distribution proceeds, may they have liquidity, that's called LP, basically liquidity preference. Then you have an anti-dilution clause. They are more valuable by 15% as compared to the equity shares. In that case, can you just take this 15% number arbitrarily, or is there a method to that?
Just curious, is anti-dilution clause is always there? I don't think so.
In most of the term sheets
Mostly
that
it will be there. Mostly.
No,
mostly
it's
it
in
will
a,
be there. Like if the Sequoia and all, they will invest.
yeah, if a private equity players invest in law, it will very much there. Most of the CCPs is issued by a lot of these private small companies for the sake of convenience. There they don't have it, right?
Yeah, in one
If the
case you are
investor is
right.
educated, they will insist.
If the investor is educated like a Sequoia and all, they will take this anti.
Yeah,
Because
If
private
it is
there is
like
just
bootstrapped and initial, then of course, promoter is driving the agreement. It will not.
So it depends on who has got a greater negotiation power. But for sure, if a Warburg Pincus, a Sequoia and all, or ICICI Ventures, all of these people invest, they will have anti-dilution clause. And it's a very fair clause that it cannot happen that you raise my funds at 2150 and then you do a down round at 900 and then you do a down round at 1200 and then 900 because you want to keep the shop going, because otherwise there's a risk of shutting down as a
But
lot
how
of
is-
startups.
But how is it fair? They are supposed to have an equity risk, right?
Yes.
So it's not fair thing. It's just that it's the flexibility of the financial muscle.
Absolutely. So the point here is that they are Sequoia, so they will have that. That you cannot take Sequoia for a ride. You can take an individual HNI for a ride. So, like for example, in case of Byju's, what has happened is that they had their valuation at $22 billion. Now there is this fund which recently came out and said that they are writing off that valuation by 75% in mark to market, because now they feel that this it was, I think, some 5 point something is what the valuation that they are now valuing Byju's shares in their books. And now if this becomes a common thing in the market, if they have to keep the show running because they will run out of funds very quickly, otherwise they will do a down round. And therefore it is actually fair for the investor to have something like an anti-dilution clause in their term sheet.
Just to share my experience, Mr. Anurag, on this.
Yeah.
This one point of, convenience valuation versus real valuation, this is what we stress to the investors, that as per my view, you are not like worth say 40 crores. In my view, you're 30 crores. I try to convince and push my valuation with this concept. This round you may be able to get. Okay. Next round also somehow you will push it. But the third round are all the intellectual investors who will never accept your valuation. At that time, you can never go down round. So you will be badly hit with this kind of concept. When you really want money, you will not get it, because at that time you will be perceived as overvalued.
Correct.
So this is one trick which I used to push him down, saying that, you think about it. You can get through now, next time, but never the third time.
That foresight is required. So people
but that time he will be really valuing money because he would have already established himself in the market. So he will not get the money when he really needs it.
So and that is actually the kind of value that you can add in the course of an exercise, so that we don't get into that issue that, okay, we are just doing stamping business. When we give the client advice like this, anti-dilution clause, what are the risks, what are the pros and the cons, etc., that is where we actually add value. So from CCPS to equity share, I have seen that normal plain vanilla reports, generally they will take, okay, 15% discount le lo, and equity share ka value will be 1300 multiplied by So what they will do is basically that if you have an equity share, you want the value of the equity share. If CCPS is there at 1300 rupees per share, the equity value will be 85% of 1300. And that again is the question of convenience valuation that happens. So I am just talking about an ESOP valuation where the company has an level 1 input of CCPS at 1300. So equity value is 85% of the 1300 value. So then this again allows the management to say, okay, you take this as 15% as the difference between CCPS or equity, or you take it as 20%, or you take it as 10%. So how do we, and there is a method to solve this particular riddle. Otherwise, what happens is in the ESOP valuation, with both of these fulcrums, again, you have attrition. Okay, so attrition again, there can be past pattern, but management can say, okay, take 15% attrition to reduce. So what will the typical CFOs ask? The CFO will say, boss, please reduce my ESOP cost. Already my company is into loss of 50 crores. Whatever charge that you will give me, it will further increase the loss. So please try to, instead of 59 crores loss, give me 56 crores of loss. Will that not be the logical ask from a CFO? So therefore, that brings a lot of subjectivity into this 15% difference between a CCPS and equity. How do you challenge this? So there is this method called back OPM, backsolve method. And that's a very fair thing. So basically, there's a mathematical exercise to this that you kind of set up the cap table and do the liquidity preference in such a way that you know that, okay, if the CCPS folk had invested at 1300, this was the implied equity value in this mine. So that comes to that entire Excel exercise. So maybe I can just show you how that is done to give you a fair idea. Okay, just a minute. I'll just show you that.
So while you are looking for that, no, why don't you just give us your view on whether you will consider the ungranted ESOP pool in the denominator?
Ungranted. No, we just go by the granted one.
Okay, because there is a certain amount of discretion involved there also, right? When it can be granted, therefore, should you not consider it?
That is potential equity, you are saying.
That's right.
So basically what you are saying is that as on today, I have just granted on the date of joining that, okay, over the next 2 years, this is the pattern in which you are going to get the ESOPs. So you are saying consider all of them based upon the grant letters.
Or there is the, with the management, there is the ability, the discretion to grant options based upon the hires which are going to be there in the company. And they will have to hire people to grow the business. So therefore, the likelihood of the options being granted is very high.
That's a very interesting question. I have never come across this in the past, because companies have mostly come and told that, okay, this is the pattern in which you have granted, and that is what you give. Okay, so I have not come, and I think that will bring a lot more subjectivity into the whole exercise, that how much you will grant at what. So you can say that there is a pattern, and of course you will have to give that grant, but you can also take a view that as on the date on which you are issuing the valuation, the safest method will be to go by what has been actually granted. So,
yeah, but you also consider that when the ESOP pool is created, the investor who is coming in has basically considered that as a part of the pre-money valuation, meaning that he has assumed that ESOP is going to be fully granted while arriving at the value at which enterprise value at which he is going to invest. So therefore, should not the entire pool be considered in the number of shares?
You can do that, factor in for a particular attrition level that can be there in the company. And that is again a very subjective call. Something like in one of the instances, the CFO of the company told me that you take a discount for lack of marketability as 10% because I want to reduce my cost. So then we did a Finnerty method and I kind of arrived at 10% justification for DLOM, because in the ESOP policy, you have a clause that the employees cannot go out in the market and sell the shares. They have to come back to the management. Only if the management so desires, they will either buy back themselves or make the employees participate in the subsequent round. So in that case, there's a clear case for DLOM. Now, discount for lack of marketability. In that case, how do you value that? If the more you increase it, the less will be your equity value, and hence the ESOP cost goes down. So that also is one challenge that is there, that how much do you consider DLOM in the whole exercise. Now, in this case, what happened was there is this waterfall analysis that happens. If the QIP is happening at 1370, you kind of, and I will not take you through this entire thing. What you basically do is that you have Series A, B, C, CCPS, and then common stock. And then you have entire dilutive instruments in terms of management options, ESOP pool, etc. So based on the converted basis, on the conversion price, what you come is that from 1370, at which the QIP has actually happened, you will so arrive at, so there is this whole exercise that happens. And on the basis of this, eventually, you arrive at the implied equity value, that what will be the common stock value. So the common stock value here is 1115. So if CCPS is at 1370, the latest series C, in that case, the implied equity value will be 1115. So that's a much better method to perform as compared to just taking an arbit 15% thing in your valuation. So this is one point that I wanted to drive home here, that as valuers, the onus is on us to really add value through methodical things so that we reduce subjectivity in the exercise. And the second thing, therefore, will also be that our value in the whole process done. So once things are complex, okay, so in that case, your value actually also increases. So the value of a valuer increases with the complexity. So you will agree with this thing. So you have to bring it the complexity has to be increased. And in plain vanilla, you'll have to live with the fact that whatever is the market, if you're selling potatoes and onions, that's how the market will treat you, like a commodity thing. So are we on the same page so far? Any thoughts on this?
Agreed.
Right. So we will, the onus is for us to really, get. And so therefore, another factor that comes is that how do we as individual practitioners get into the larger scheme of things and kind of become a name, which is not Big Four, but not like a rookie or a small time practitioner also. See, because I have faced the same challenge in IBC also. In IBC also, the liquidator, the IRP who comes and says that, Anurag, I want this particular value as a fair value and the liquidation value. And आपको ये मेरे को ये certificate आप बना के दे दो. And मैं आपका bill process कर दूंगा. In that case also, for example, how do you really get the liquidation value as on the date of the commencement of the CIRP proceedings is a kind of a question. And the worst part of this whole IRP valuation is that the ticket size is so sad. 15,000, 20,000, beyond that doesn't happen only. So then how do we really get out of this rut is one question that I keep asking at various forums. That as a profession, how do we really bring our collective cloud? Like you see in the case of Byju's, Deloitte took a stance eventually that revenue recognition that was happening of the 4-year revenue on the sale of tabs being recognized right away, that should not have happened. And they kept the signing of the report hanging for months and months. But that was Deloitte which had that muscle power to do it. And maybe in the past, there would have been so many compromises, but now under the MCA scrutiny and all, audit firms have become all the more circumspect about really letting this keep happening. So I was recently talking to another startup for which I would be potentially doing ESOP valuation. You will not believe that they have raised Series B. And one of my known ones joined there as a CFO. They have been doing cash accounting, cash basis of accounting so far. because there was some semi-qualified CA over the years who was just managing the show. Founders were techies, so they didn't really have any understanding. Cash-based accounting for a company which has raised 30-35 crores of funds from overseas investors, Singapore parent, everything is there. But accounting, core accounting is cash-based, accrual-based. So various things that come on with the practice happening. Now, so I will just run you through some of my slides also. Then I'll keep looking at various other aspects also. So defining the value of an entire company can be challenging for large competitive business markets. Well, the main goal for many companies is to increase their market value. The should be that what are the advanced techniques and what are the best course of action. So number of factors like historical trend, growth prospects, management experience, market share, business cycle, macro level changes, government regulation. So the best bet for us is to actually consider all of that complexity. And eventually, I think if the collective bargaining power of the valuers as a profession increases, then we should be in a position to actually question all of that. What are the secular trends in the edtech industry before we arrive at a particular valuation? Post-COVID, are we again shifting back to the physical classroom method? In that case, what will happen to our valuation? At what stage of the business cycle you are? Will government regulation really, are there any changes? And all of that, once you plug in into your considerations, your value as a valuer increases. Because the more complex analysis that you do, instead of a plain vanilla DCF, applying a VAT, taking a beta from Ashwath Damodaran's website and just arriving at cost of equity, etc. So then the whole question is there. So now the question here is, see, Ashwath Damodaran is here. The whole country blindly follows Ashwath Damodaran's beta for Indian markets. You've seen that as a practice, mostly everyone does that only. In fact, I also do that only. And there is, once you utter this word Ashwath Damodaran, so you will say, okay, textiles industry, I went to Ashwath Damodaran's website and I took the unlevered beta from there. No questions asked. That becomes like a Bible cast in stone. That number happens. Has any one of you actually taken something else for unlevered beta?
Yes.
You can take listed comparables and unlever them and then relever. That is another method. But in most of the reports that I have seen, mostly people just try to take Ashwath Damodaran and it is like the Bible thing. There's nothing beyond that. What is the risk in that particular process?
The comparable set may not be the true comparable set.
Yes, exactly. So that is the biggest challenge, that he might have run it on the basis of 5 companies and you really don't know whether they were representative of the kind of business that you have. So in that case, how do you arrive at that? So for example, I have recently done a lot of edtech valuation. So K-12 as a segment is a very different segment as compared to the larger edtech place. So someone who is coaching for IIT JEE and UPSC, the dynamics of that business are very different from K-12. So if you take the same edtech multiple for both of this, it will be highly different. So for example, if you're doing a CA coaching or IIT JEE or UPSC coaching, as compared to K-12, what is the difference in the business dynamics or the risk? I mean, on a broad understanding, what is the difference between one of your clients who caters to K-12, means KG1 to 12, that school education business, vis-a-vis IIT JEE, UPSC, CA education? So in terms of beta, which really represents the underlying systematic risk in the business, how would that be different between K-12 and IIT JEE, UPSC?
See, in K-12, actually, you're having a lifetime value of the client, which is far higher than in the case of, let us say, a coaching class, because that lifetime value of the coaching class client is just about 1 or 2 years. So
Yes.
you have to consider these factors while deciding on what is the earnings which are going to be there in the company.
Yes.
So based on this, you will then get to the beta, etc. I mean, you have to find comparables, companies which are more comparable than, let us say, the coaching classes. You will find companies which are K-12 oriented.
Yeah, in India, but yeah, so that challenge which I faced was that in India, I could not find any K-12 listed companies.
K-12 is a not-for-profit approach, whereas
No, no, no,
training,
no, no, no.
yeah, school education which you do, you're talking about education, right? School education is a not-for-profit trustee oriented.
No, no, coaching for K-12.
Acha, coaching, okay.
Both are coaching businesses.
Like Byju's.
Yeah, like Byju's. So here, so there are different differences here. One is the parents' involvement is very different. In K-12, the mother will be equally involved in the exercise as compared to an IIT JEE or a UPSC, where it's an adolescent whom you are treating. So, and then this business is very glamour oriented. The moment you have 5 people from your institute cracking IIT JEE, you will suddenly find that your enrollment shoot up. And 1 year, you don't get within top 100 rank of IIT JEE, the enrollments don't happen. So from that perspective,
Market reputation.
market reputation risks are very high in an IIT JEE UPSC business. In K-12, again, someone who is, if the teacher is teaching well, the parent is happy at a class 3 level, someone will not really bother, because your test of baptism means that you get that risk happens at class 10, 12 level. So the parent can always think that, okay, my kid is at class 2, class 3. So even if the class 10 results are not there, so that this life cycle is quite long enough where you can change the trend. But in case of an IIT JEE, because the life is just 2 years, class 11 and 12, there's a short-termism in the whole approach towards glamour, that if you don't perform, you are out of the market very quickly. Okay. And again, here, the teacher's reputation means basically you are also the key teachers that you have. For example, there was this Bansal tutorials in Kota. The moment the key teachers of Bansal tutorials moved out to Resonance, Bansal tutorials was finished. Okay. And then again from Resonance, once the teachers started getting more traction, they also moved out and formed their own academy. The same thing happened to Allen, which recently was the subject matter of a private equity transaction. So here the main teachers who you can say as your star educators. So when we do valuation of any large, these kind of chains like a Bansal tutorial or Allen and all, the role of these star educators becomes very important in CA also. In CA, whether if it is Praveen Sharma in the North India markets for accountancy, if Praveen Sharma is a part of one coaching institute, the student will go there. And the moment Praveen Sharma goes out and forms his own institute, the students will all shift there. So the performance of star educators becomes all the more there. So this is just one example to understand that businesses, apple to apple, will not be there. So relying on some broad multiples again is a challenge. So Einstein was right about relativity, but he would even have had a difficult time applying valuation in today's stock market, like Ashwath Damodaran. And Ashwath Damodaran, but on a personal note, I really respect that person. When Zomato had brought their IPO, Mr. Damodaran actually created a valuation model, if you have son, and I will just show you if I have that. What was the IPO price for Zomato?
150 around.
71.
71, right? Mr. Ashwath Damodaran at that point of time, defying all kind of conventional wisdom, had comes, and you can see my screen, right? This is the financial model for Mr. Ashwath Damodaran thing. See, at that point of time, he said that this is worth only 41 rupees. And he had tweeted that staking his reputation for a company which comes up with an IPO which is superly successful, and after that, that IPO goes up to 160, 165 levels. And that point of time, what will you think of a person like Mr. Ashwath Damodaran? That this guy is overly conservative. He just is not really worth it. 40 rupees is what he has valued as stock, which is at today trading at 165. So the IPO price was 70 rupees. So he clearly said that price as a percentage of value is 171%. And most of people would have scoffed at the idea, okay, there is this professor at NYU's turn. How does that matter? The market is more powerful, more fair. But what happened eventually? Zomato price did fall down to 41 rupees. Right?
Yes.
If you look at the share price of Zomato, and that was like, the true validation of a professional, that what he said was correctly happening. So Zomato, which had seen the highs of, so see, if you look at Zomato, it had gone up to like 155, 160 levels, finally fell down to 46 rupees. Very close to what Mr. Damodaran said. So as a valuation professional, that is where, and this one example can completely change the perception that the market has about your numbers, because he was someone who really took that risk to reputation by taking a call on something which was traded, which has an IPO of 70, which was eventually moving to 160, but he stuck to his conviction that no, I still believe that this stock is worth some 41 odd rupees. And eventually market forces so ensured that we found him to be correct. And one such instances can be an inflection point in your entire career journey. Okay, so that relatability of valuation is there. So the challenges in the valuation is that there is this unique product or business model. So how do you really value a robotics tech company? The dynamics of this will be very, very different as compared to K-12 or as compared to IIT-JEE. So there are some uniqueness of this robotics thing. So something like a white hat junior. How do you really value a white hat junior with something in a very unique model? So there are no comparables. In such cases, for us as a valuer, there is a challenge. And we have already discussed about no history or small revenue loss making companies, because relative valuation really is meaningless in such cases. And forecasted projections going to be aggressive, not in line with expected growth rate. And then illiquid investment. So you lack liquidity. So when you talk about DLOM and DLOC, this really is there, that you really don't have liquidity for these kind of valuations exercises. That if today I subscribe to this particular investor startup, which is into, let's say, wine business, and they are setting up this brewery and this and that. If I don't want to invest, subsequently want to get out, what do I do with that? So I was getting a fractional CFO assignment at a particular company, which said, boss, I can't really pay you cash. You take my phantom shares. And our next round will be at 2x valuation. So this 3 lakh rupees of phantom shares will be worth 6 lakh rupees in the next round. What is the risk? Instead of cash consideration, you are taking these kind of shares as your consideration. Then this question of illiquidity comes into the picture, because tomorrow, if I were not convinced about that assignment, he might fire me from that virtual CFO assignment. In that case, what do I do with those phantom shares? Because I cannot go out in the market and sell it like a Reliance or any other thing. So the possible challenges that may require a lot of estimations for a company with no historical data, or a loss-making company, is that the cash flows from existing assets in terms of the whole DCF exercise, is that absence of historical data make it difficult for you to assess how well the revenues from existing assets will hold up. If microeconomic conditions become less favorable, the lack of data from prior years also make it difficult to analyze how revenues will change if the company changes its pricing policy. And I'll give you an example of yesterday only. Yesterday, an assignment came to me. There was this company which is into Goa. They are into some wellness thing. So what they are saying is that we have a center which has a capacity of 600 participants per month. So basically, what they are saying is that we have a 3-night, 4-day wellness workshop at 35,000 per participant. In November, we ran a very good batch of 40 people in the batch. We clocked revenues of 14 lakhs. Now they are saying that, bhai, you make a valuation report for me, that assume that since we've got very good 5-star rating on this particular batch, so now every month, imagine that all will be running full capacity, 600 participants will be there. and this keeps on growing, we will add more centers. So we are looking at 100 crore valuation. Yesterday, this assignment came. We had a half an hour call on this. What would be the challenges to your mind on that? And there is validation in a way. There is a batch of 40 people who've come out there, given them 5 stars. So they have clocked revenues of 14 lakhs. They have a center in Goa. They have a very good program structure design. But how do you really factor in? Can you really say that, okay, whatever the promoter is happily asking for, you will give it to them on the paper?
No.
Yeah, ideally you should not, because what is the risk? There could be a lot of optimism bias here. Because what holds good for a batch of 40 people might not hold good when they scale up.
Promoter's background.
Yeah, promoter is 6 years into so in fact, the promoter is also a chartered accountant who did a lot of tax and stuff and later moved to spirituality as a business. So you'll feel very happy by talking to the promoter. The content is very good. In 3 nights, 4 days, they really make you feel very, very amazed. And I've seen videos of their testimonials and all, very good. But then can you really look at a 100 crore valuation, assuming that there'll be batch full for, because if this business runs on 600 participants, 30 who pay 35,000 in a month. So it's like a 2.1 crore business per month, which means 24 crores per annum. And this is like a 80% EBITDA margin business, because all the cost which is there is of, you have to give them some clay and some coloring pages and some music and some food for the 3 nights, 4 days. So he says that it will be at best 20% will be my total cost. So in such a situation, how do we value is one question. That cash flow from existing assets is the question. Expected growth from both new investments and improved efficiency on existing assets. So here the promoter told us that, okay, there this 40 batch that we've run, now we will be running at full capacity the moment we start getting marketing funds. So that's a tough time that we will have estimating future growth in revenues and operating margins. And then discount rate is no way in which we can run a regression on past returns to get an equity beta or use a market interest rate on debt. So you really can't even, since it's not having a credit rating, you don't even know that what should be KD and KE. So the whole challenge of even WACC is a thing. And then terminal value, again, what is the largest thing in terminal value is this question of growth. And in a lot of exercises, growth is taken as a balancing figure. In fact, is there any scientific method? I have not been able to figure out any scientific method to arrive at growth. So you can look at retention ratio and apply that by ROE to arrive at growth. That has been the traditional method that we have. Because whatever is retained in the business, that will generate return on equity. And so that should be a proxy for growth. But in case of startups, how do we apply this? Any thoughts on this? That how do we really get a right number for growth?
The mere mentioning of a startup, that means growth will be ununiform or something which will not be uniform. There's no question of that. Deriving a terminal value is essentially a mathematical expression of a potential future value at a constant growth. If the growth itself is not constant, you cannot simplify it to a single numerical value using that formula.
So how do we address this challenge then for terminal value?
Either we project it until we believe it will be a constant growth. So that's the first assumption. Until we believe, till that time you are supposed to project it. If you don't believe that, until that time you cannot do it.
In the VC world, beyond 3-4 years, no one really cares.
Then essentially you look at the market multiple. So given this company reaching at a particular stage, typically what market values could be the implicit method to determine the growth rate. If the market perceives a typical such an EBITDA percentage margin, such a typical turnover company is typically valued at this particular multiple, use that as a basis to derive the implicit growth rate.
So there has to be some level 1 input in the whole validation exercise. So again, G becomes eventually guinea pig. Becomes the
it has to be.
figure.
Otherwise, it is not possible.
Yeah, so we were doing valuation of a construction company, which we had to find out G for the growth rate. And then I took up L&T's 10-year CAGR in terms of revenues. I said it was 7%. They were not very convinced about that 7%. They said L&T has got such a large base. We as a company, we are only 500 crores. We will grow much larger than 7%. Now, how do you really quantify that much larger?
What is the return on equity? The point is, end of the day, we are looking at a return on equity which is higher than the cost of capital, and that
Yes.
that differential is actually the profit margin for the company, and therefore the value is in excess than the return on equity. So
Yeah,
if
correct.
even though your company is much smaller than L&T and you can grow faster, but if a return on equity is lower than L&T, then essentially you have a different challenge altogether.
No, it is good. So what the question there is that it's a question of small base vis-a-vis an L&T. So for them, what they are saying is that, okay, you just cannot, what I proposed to them was that 7% has been the historical 10-year CAGR for L&T in terms of revenues. So after your 3-4 years of the explicit period, I will want to plug in a terminal growth rate of that 7-8%. But they were not very happy because they said we are just a 500 crore company. L&T is a 50,000 crore company. So I think my choice of comparables from that perspective was wrong, because I should not have proposed to them L&T. I should have proposed to them smaller companies. H model can be used. Acha. Mr. Murarka, how will that work? If you can just shed light for us, that will be good learning for me also.
We're just coming back for a moment to your L&T example. No? To use a terminal growth rate of 7% for a company is also probably unrealistic. No? Because if you are trying to say that this company is going to be there in perpetuity, 7% is actually a very high rate.
Absolutely.
I don't think even L&T will be able to achieve that.
But 7% is nominal, right?
That is nominal, but it's not real. No, yeah.
If its inflation is around 2-3%, 4% over the next 10, 15, 20 years, which is expected, then
7% from that perspective is okay. GDP growth also is normally like that. Then you can take the elasticity of the industry with respect to GDP. The various ways. 7% on a nominal value should be good.
Okay, so let's assume for a moment that that's there, Anurag. Now, suppose, let's say you have this company which is comparatively younger and therefore is able to get a higher. The key is market share. How will they get that market share, and what is the USP which enables them to get that market share? As compared to, let us say, L&T, which if they are in the same market as L&T, which has a certain way of, it has a well-set market approach. It has a certain market share which is well defined. It will continue to grow at 7% industry average, let's assume. So how will this other company, what is the USP it has to give it a higher market share than L&T? I mean, a growth rate in the market share.
So these
that
are
if you have,
players.
then you'll be able to get to the, then you'll be able to get to a growth rate which is justified, I believe.
So, their argument was that we are at 500 crores. From 500 crores, they are very strong in Rajasthan as a belt. Okay, so they are saying that, okay, in Rajasthan, it is, just another 100 crores and 500 crores and another 500 crores is cakewalk for us, given the state of Rajasthan market, and we are very, very strong there. So we are saying,
I think that we can't really rule out what the promoter says in such cases. We have to listen and see if the story is justified.
Yeah,
I think that's
and
important.
Document that. So you can say that I think the best method is to caveat that in the report, that if you look at broader inputs, the growth rates of companies in the construction space are this. However, management feels that given the localized play, the institutional strength that they have in the state of Rajasthan, they will be able to grow at a faster rate. And because of this, we are able to justify a higher growth rate and come to our valuation numbers.
Can I say something? Same thing on this as Abram is asking here. Finally, sustainable growth rate is a function of return on equity and retention ratio.
Yes.
So two things we need to answer. If the company is able to get a higher return on equity than L&T, so that means if they are getting higher return on equity than L&T, something is wrong with L&T or something is good with this company. That is something we need to justify. The second aspect in this is how much plowback is happening in terms of retention. If L&T's retention ratio is much lower because they as a company give away dividends as compared to this company, there are two things that comes up. A is L&T doesn't perceive that they need not keep so much of capital with them because they look at market only as so much and therefore they give back dividends. Whereas this company believes market is much better and therefore I can plow back. If you are able to justify on those two elements, then you can justify a higher G for this smaller company than a L&T.
So again, so therefore there will be a method to this thing that you're right in saying that L&T and the capex requirement also for L&T could be very different from this particular thing, this particular company, and they could also have more funds. So yes, so if you can actually document that understanding, I think as a valuer, our life will be fairly sorted. So I was doing
Shall I add
valuation.
my opinion? In case the company is a real estate company, like building some multi-story complexes, etc. If the bookings are very fast or reasonably faster, then I can rely on the growth story of the company or the projections of the company.
Yeah, and articulate that. So my humble submission here will be that whatever has been the reason why you have been finally convinced that, let's say you eventually settle down for a 10% terminal growth rate. Please articulate all of those assumptions in your report that tomorrow if someone comes, God forbid, and questions your understanding, you should have that, okay, this was the validation that we did. We compared ROE, we compared retention ratio, we compared the booking pattern, we compared the localized play. Whatever we did, we should actually document all of that. The only question is that, okay, for a 15, 20,000, 25,000 exercise, how much time should we have to do that whole validation and to document that? Because then the whole question is, we are looking the return on equity for the client, but we should look at our ROTE also, which is our livelihood, as well as return on time invested. So that also is a thing. So that's one question. So, because what happened, for example, I was valuing this company, which was into, online pharmacy. Okay. So where this company was into online pharmacy, there are a lot of international players. But then if you look at their EV to revenue multiple, and the other part is that EV to EBITDA cannot be applied because all of them are loss making. So you have to only go by EV to revenue. So let's say it came at 3 times. The promoter was not happy with 3 times. He said, that's a very good thing, Mr. Vijay Kumar. Terminal value is not 50 to 100% of discounted value during the projected period. So it should not happen that the entire valuation will be based only on terminal value. That during your entire explicit period, it is loss. The last year it swings into profit and the whole game changes. So that is there. So then they said, okay, in India, we will grow much faster, and hence 3 times EV to revenue should not be good because those are mature markets. In India, we've just hit the tip of the iceberg, we've just scratched the surface, and hence online pharmacy, so it will grow like phenomenally. So you give me 5 times or 6 times, then only. And there are very, the objective of that valuation was not pass-through piling. In that valuation, it was that they were issuing debentures on the basis of those unlisted shares, and they were offering a security cover. Now that becomes all the more tricky, that you are raising money from the market. You're saying that this security is there, which is this unlisted share, and this is worth 40 rupees a share. And they have to justify 40 rupees because they don't have more shares than that. If you are to, they have to ensure a 3x cover or 4x cover. From that situation, then what happens is that it is quite a tricky situation. That as a valuer, what do you do? And they say, "Arey bhai, aap compliance ke liye de do, chalega," something like that. So that is one pertinent issue in valuation. And I'll show you, relying on this management representation, how that can be quite a thing. So So Byju's, I analyze the valuation reports of Byju's. Okay. Set of valuations. So there was one valuation report of Byju's, and you can log into MC and check them. So there's the same registered valuer from Calcutta, my same city, who has issued the valuation report for Byju's on 31st August as well as on 30th November. Very interesting situation that for the past it is fine. FY20, FY21, the same numbers are there. Loss of 305 crores, loss of 4564 crores. Now for FY22, there was 7 months remaining when he issued the report on 31st August. He projected a profit of 125 crores. And on 30th November, just 4 months remaining, he projected a profit of 209 crores. Then for the next year, as for the first report, the profit was 382 crores. And it swung into a loss of 692 crores. Then the profit for the next year, 1243 crores becomes 611 crores. But then since there is a next round is at a higher value, immediate future you are making more reasonable. And what are you doing? Because you have to arrive at that value, you are increasing year 25, 26 and just plotting it and arriving at your number. And these are real-time valuation reports. What would be your opinion on this? He writes very conveniently in his report that I have relied on management representation and this is the trend. 4564, 4564, this is fine. 125 becomes 209. So what you are not earning in 7 months, double of that you are earning in 4 months. But next year you are swinging into loss from 382. And then 1243 becomes 611, 2498 becomes 3323 and 5978 becomes 8869. Happily, both reports are signed. Estimates are not acceptable, but I'll show you the valuation report.
Can you give me one more input here, which is missing?
Yes.
Has there been any material change in fundraising between the period?
At a higher round,
Doesn't matter. The cash flows that he has shown in the March number, for example,
yes,
and the cash flows when he has shown for the November, in between March and November, has there been a fundraising?
yes, at a higher round.
Yeah. So what typically happens, in my view, is it's a justification to the valuer. Whenever a fund round happens, there's a surplus cash flow and there's a business strategy that you can change. So the business strategy is that, okay, earlier when you did a March round, you are not sure whether you have the surplus cash flow to follow a particular strategy of aggression. Whereas once you get the cash flow, when you're re-looking at it, you can do it. Assuming that event has happened, you can have the change in numbers.
But then the immediate future should also be rosy, no? That you have made it more loss making within 3 months. And you're right. I mean, that can be a very, very good argument to justify this hypothesis. So this is the report as on 31st August, and you can download this from MCA. And this is the report as on 30th November, from which we have picked up the number. Same valuer, everything same, just the underlying numbers change and the valuation moves up. So now it is, and this was the other thing that I was talking about, these numbers, 0.7, this conversion from CCPS to equity is convertible. Management has represented that Series A CCPS is convertible into 0.9743 number of equity shares. And hence the value of CCPS, in my opinion, can be considered as this. This is again one major challenge, that management cannot represent this. There has to be a method to this. So on 30th November, he gives 1,75,000. And on 31st August, he gives how much has he given? 1,70,000. Now, this is one challenge that you will face in doing consecutive valuation of a company with this kind of governance standards. Had you issued just one of these reports, your reputation risk would not have been there. Your name would not have been a subject matter of discussions in newspapers and in discussions that how can you issue two reports on the same day? That would not even have happened. But here, because it is the same valuer who has come up with two numbers within the span of 3 months, this whole question will come. But then the question will be that if you get an assignment like this, for you it is repeat business, and the conventional business strategies always say that one should get stickiness of clients. Always, every day you can't dig a well and drink water. You should have repeat clients. So in the world of valuation, repeat clients will come up with repeat stories, which are very, very different. In that case, how will we justify our existence? Any thoughts on that?
I
Well, I
have no
think that you
problem
have
in
to
changing
look
it.
at it a little bit more. It cannot be black and white. No. So, for instance, suppose you have a repeat client whom you've been doing valuations for the last 3 years or 4 years, for example, and the performance is pretty good. Profit is there, revenue is growing, the brand equity of the company is growing. However, there is no clear plan for them to raise money. They don't need the money. So you have constantly, let us say, some set parameters, let's say % times of revenue or times of EBITDA. Each year, over 3 years, you use that valuation, company accepts it, you're doing the valuation, everything is fine. Now, after that, the company goes out and says that it wants to raise money from new investors because it wants to go into an IPO. So you've done a valuation, let us say today you've done a valuation. After 3 months, the company comes to you and says it wants to do an IPO. Obviously, the value will go up, no? So
but
there
the
is something
pattern,
which
that is fine. I mean, directionally value going up is fine. But the details of that is where my question is. That underlying that valuation comes from the DCF model. In the DCF model, if this kind of swings are happening, 125 becomes 209, 382 becomes negative 692, then again this profit becomes half. But then you say that, okay, for the next, ultimately I have to arrive at a higher value, and hence let me give a higher number in the terminal year so that terminal value gets increased. That is where my challenge is. So you look at the
But
CAGR here. This
you
was
have to
more
get all the
reasonable.
facts before being able to take a
No,
informed
I'm just,
judgment, right?
let us take it as an illustrative thing. This becomes 1243 becomes 2498, 2x, 2498 becomes 6000, which is again 2.5x of sorts, which is still okay. But here the story is a loss of 692 becomes 611. And then from here it moves 5x. In fact, rather it's 5.5x. And from there again, it becomes 2.5x. This is PAT projections. This is where we should actually apply our professional judgment and look at ways and means where at least we can caveat our position because of the whole reputation risk that is there.
I would
I
add
agree with you
further
about
one more
that.
thing.
Right.
I would add one more thing here. Between
Yes.
2 rounds of funding. So today I valued on 30th March a particular value for a given set of cash flows. Thereafter, I had a valuation round. Okay, it could be at the same price, doesn't matter. It need not be at the higher price. But after the funding round, within 3 months, the value can, given the projections being the same, the value can still be higher. Because when you did a valuation on 30th March, you have estimated the risk of the company's ability to raise capital flow, which is the essential requirement for the company to perform a particular business strategy. Therefore, you have estimated a particular risk and therefore the cost is so much. But if the company was able to raise funds and the capital comes into the company, then essentially the ability for the company to achieve its projections is far better. So same projection, but the risk has come down now. And given the risk has come down, the value can go up.
The WACC will improve.
Yeah, therefore the answer is between 2 short periods, whether the valuation can change either in the revenue side or on the cost side, yes, it can change. The reason is it's a function of the storytelling of the business strategy and the certainty of that. So I would not suspect that in this case. I mean, there are other things which you all suspect, but given this, we don't need to suspect.
Yeah, you are fair in that. That can happen. And I will finally show you one another thing. Just a minute. So here in this situation, I am showing you a tax ruling where the department has questioned that arithmetical exercise wala thing, that I might not have that report here. Acha, that may be for some other day then. The department has questioned that arithmetical exercise vis-a-vis that independent matrix that we set now, that becomes like a counter loop. So I had that ruling. I don't know. I'm not able to find that right now. Okay. So that is there. Okay. So going forward, yeah, then it should be pre-money valuation and post-money valuation only. Correct. Okay. So to continue, business model. Now, the other thing that we wanted to talk in today's agenda was the valuation of intangibles in terms of brands. Okay. And so brand valuation is where actually you can add a lot of value. And that is one aspirational case for me also. I tried doing this for a fertilizer company, but the challenge that I got was there were no comparables of. So in brand valuation, you typically apply relief from royalty method. So in this question, then what happens is that this royalty rate is the major question. And in brand valuation, it's far more subjective. Unique product, hence the attributes are not quantifiable, very subjective. It might lead to different valuation for different analysts. So how do you value Tata as a brand? This becomes a far more thing. So Tata or Nestle or any brand for that matter. So look at the kind of valuation these brands have had. Look at the valuation of a Google, Apple, Netflix, or these kind of brands, Louis Vuitton, Samsung. What would be the best method to value these kind of brands? Relief from royalty or anything else? Yes, anyone?
Not easy.
So right. So what is the right good method? Relief from royalty, or is there anything else also here that you can
Relief from
apply?
royalty is a most appropriate method.
Relief from royalty is the most appropriate method. But yeah, now please address this question, which actually I also faced. Then eventually we could not proceed with the. So here was this company A wanting to do a merger with B. So, and you know, there are big money at this face value of this company is, I mean, the net worth of this company is 20 crores. They want to do this merger at 120 crores, and excess consideration in terms of PPA, they want to allocate to goodwill and then brand. Within the same promoter entity, they want to do this. And what they will do that on this brand, then they will take a tax shield. And that is why a lot of these tax professionals are nowadays advocating these kind of mergers, which can happen because then they do PPA, and within PPA, because the fair value is only 20 crores, the remaining 100 crores, there's a lot of things you can do, assembled workforce, and you can do brand and goodwill, etc. And then there are depreciation aspects that you can have. So recently, for example, one of the companies in the fintech space in Bangalore, they transferred a brand from the wholly owned subsidiary to the holding. Wholly owned subsidiary, the book value, let's say, on that brand was 10 lakh rupees. They transferred it to the holding company at 20 crores. And this, will that attract tax? Wholly owned subsidiary to holding company? This is a fully exempt transfer as per the capital gains, because this is from a wholly owned subsidiary to the holding. Now, the advantage that the holding therefore has, you don't pay any tax on this leg of the transaction. Now, the holding will take a depreciation on this brand over the next 5, 7 years, 10 years and claim a tax shield. So this is a very interesting play that is happening in the market. VVN, what is VVM, Mr. Prakash? What is VVN?
Sorry,
It must be with and without.
method.
with and without method.
With and without method. No?
Yeah. So that is one method which we can explore. Basically, if there is a brand associated or if it is not, obviously it will impact the total revenue, right? That was the idea.
Exactly. So what is the So I was doing this exercise in a workshop that when Tata's paid this, or in fact, this transaction has not been consummated, 7K to 8K for Bisleri. What essentially had they paid for? Tata Consumer Products.
Brand name.
Mostly it is the brand, because I think for the Tata Consumer Products, getting contract manufacturing, they already have Himalaya and all of those brands, Copper Plus, etc. They have that distribution chain on which these brands ride. The whole thing was that in India, Bisleri and mineral water are in many ways synonymous, because Bisleri had actually introduced this concept to our country. So from that perspective, how do you ascribe a value with and without method that this mineral water bottle cost 20 rupees? What is the generic play here, that without the Bisleri sticker, will it cost 12 rupees or 14 rupees or 10 rupees or 8 rupees? That is a very subjective thing in the with and without method, or then the relief from royalty method.
See, the more and more I think about brand valuation, I think we as valuers cannot be devoid of some kind of a market research support in our documentation. So invariably what happens is, what you just asked, whether it will be 12 rupees or 14 rupees, when you go to the market and you do kind of a little bit of market research, and that's a market research techniques are there, where you figure out as through a sample population, and you come out with a data point, which can be the inputs for your decision making of with and without method or such things to determine the brand value.
Yes. So therefore, if you are in the business of brand valuation, you actually need a lot of market research, because that is not as easy as a DCF from that perspective. It is not a arithmetical exercise. Here you really need to have a pulse of the market through data, where you might have, let's say, a market research agency which goes out in the market and says, okay, this generic brand, generic bottle of bottled mineral water costs this, the substandard brand, which is there's some aqua bank, we have just launched a brand, this is what it costs, and Bisleri costs this, and this is a superior pricing power because of the Bisleri brand. So that market research, you've hit the nail on the head, that yes, that is what it really matters. You must have access to market research data here, otherwise this is just an arithmetical exercise and subject to then a lot of piercing later if that is questioned or challenged by anyone. Like we had this fertilizer case, we could not proceed with the thing because there are no companies in India which remit royalty overseas, and hence there is no listed player and no unlisted player also in the fertilizer space. Now I proposed to the client that, okay, if there is not fertilizer, but you have a Nestle, a Unilever, etc., this, who has been doing a lot of this kind of brand royalty remittances, and the median of this comes at 2.5-3%. So we can take it at 2.5-3% for fertilizer also. But the client was very finicky that, oh, you don't have an industry database, you don't have access to this, then we cannot do this. So that becomes a thing that how do you really value this? So valuing unlisted companies, we have done this. So we talked about the problems. What we can do as a thing is that mix, match, and adapt methods, trying to work around various methods like with, without method or relief from royalty method, discussing with the management if the forecast is not idealistic, as let's say, if I were to do that in the case of Byju's, that you can't have one trend like this and one trend like this, then that becomes a major challenge for me to sign off. You can add premium for extra risk and liquidity. And in case comparable companies are available, please use the peer multiple. VC method can be used. VC method is a very straightforward, very nice method that I recently learned that, okay, they don't bother so much about DCF and all. They will just look at exit year EBITDA and say, we will take 4x on that. So this will be the post money or valuation. And then we'll go to infuse this. And then, so this becomes the exit value, EBITDA in year 4, multiply, let's say, by 4x. So this is the exit value. So this becomes like an exit value. And then the VC's IRR for 4 years is 30%. So this is the post money valuation that they can give you today. But the whole valuation happens in 6 lines. That's it. So you talk to the revenue. So you talk to the management in 4 years from now, what is the revenue and EBITDA you can have. So 2x revenue, 4x EBITDA, exit value. My implied IRR is this much. And hence this is a post-money valuation that I can give you today. SEBI has actually brought out a recent paper where it says that many new age firms do not provide a basis for valuation. So if you look at the DRHP, that never talks about the basis for valuation. They say that, okay, there's a merchant banker and the investors who does this. And therefore, SEBI says that there might be unjustified valuation, that there is no check. And current disclosures are not there for startup companies. It's more guesswork than valuing mature companies. And SEBI really, so this happened in the first part of the year where SEBI brought up the consulting paper. Then in the September of this year, SEBI actually questioned a lot of Cat 1 AIFs about the valuation of their shares. So they did a lot of that story and that happened. So SEBI and so regulators are also taking cognizance of this fact that several companies are using inflated numbers, aggressive accounting to maintain their valuation, leading to distress for the investors. So if SEBI comes and asks you, then, and nowadays regulators are really, if you look at, for example, I get perturbed by the fact that, let's say there's this Chinese company which is involved in money laundering. The first person that the MCA calls along with the company's management is the chartered accountant. And say that, okay, you are equally responsible. So now what is happening is the SEBI wants firms to justify their share price valuation similar to valuation of shares for corporate issuances. The new proposal will ask companies to disclose their KPIs. So for example, if it is a Zomato, you will have to disclose in the DRHP that how many deliveries that you are doing, how much money are you making in a delivery, what is your market share, etc., etc., rather than just valuing it on the basis of EPS, because for them, they will say that my EPS is negative. I am in the stage of acquiring a market share and hence I have to burn cash. So from that perspective, you talk about operational KPIs. So all material KPIs will have to be shared with any pre-IPO, whatever you shared with any pre-IPO investor in your pitch decks in the years prior to the IPO, that also you'll have to disclose as part of your DRHP. So they want to tighten IPO pricing rules to, and things, a lot of corporate governance issues are also happening. Like case of Nykaa, what did they do? If anyone has been following that story recently, what did they do for Nykaa? In Nykaa, what did the management do, which was a serious corporate governance questionable practice?
They announced a buyback just before the release of lock-in of the earlier.
Not buyback, something else.
Bonus issue.
Bonus, sorry, bonus.
They issued a bonus. So what did that happen? What did that do?
For the temporary period when the lock-in was released, they could not sell because the price will abruptly come down because the market will presume the bonus.
So actually that they then postponed the listing of the bonus shares by 3 weeks.
Correct.
So that 3 weeks cushion they got to manage the whole show. And that became a major thing that, okay, Nykaa has done a bonus shares to avoid this. Paytm is now going for a buyback. So what can be happening is a big question.
But Mr. Anurag, if we can discuss one thing as to, they are just trying to ensure that, the existing investors, not the public, other than public, they are not, getting, they are not able to push the market, abruptly. But then why is it seen as a bad governance is just if you can 2 minutes, you can give your view.
No, it is actually bad governance. So when does a company issue bonus shares? Where it has earned a lot of profit, it wants to capitalize the reserves.
Okay.
The intent here is to postpone that sell-off after your lock-in. So that the whole intent of this exercise is wrong. The CFO of Nykaa immediately after that exercise resigned, Arvind Agarwal, because he would have also sensed that there is something which the management is doing which is not correct.
The independent directors also were questioned as to whether they did their role perfectly in agreeing for this.
Independence director in India is a farce. It is a 20 lakh rupees per annum luxury that branded people get.
from companies. So, and you can time and again see, there have been very little instances where independent directors really did something which was expected out of them. So you are getting happily 20 lakh rupees per annum, 40 lakh rupees per annum just for attending board meetings. And just what happens on the company website, on their brand, they will say, oh, I have the ex-PwC director, I have this as my independent director. So they are just lending brand names. I think that's a name lending exercise rather than performing anything else. Time and again, you see independent directors just don't do what they are supposed to do. And can they actually do that? Again, this is the whole thing of, conflict of interest, which is there. The company which is investing you, which is paying you, can you really go against that company? In case if you do that, who saves you? Same thing which happens in credit rating agencies also. This conflict of interest, there are white papers on that I am paying you 20 lakh rupees to give me A+ or A plus with a positive outlook rating. Can you actually, so out of the Diwan Housing Finance, overnight, all the credit rating agencies suddenly realized that a AAA rated paper became junk. Did they not have any preemption to that? Of course they had, but how could they do that? Because DHFL was only paying their quarterly bills. So this whole challenge is around, can you actually have some independent regulator paying you instead of the company? Like in case of a government audit, at least that is very clear, that you go and audit a PSU, that conflict of interest is not there because you are appointed by CAG. It cannot happen that if you raise 4 points, next quarter you will not get that assignment. But here, this whole, whether it is a valuation, whether it is credit rating, whether it is independent director, there is so much money on the table, which is there just for nodding the head, that how many people will have the spine is the question. Any thoughts on that?
That's why the regulation on the professionals, right? The end of the day, whether it's an auditor, whether it's a valuer, whether it's a rating agency, why regulators come heavily on them, or rather they should come heavily on them, is because of this purpose, that a short-term advantage of a potential client giving you money for you to change your undermine your professional ethics, eventually should take toll by the regulatory authorities' actions. If that does happen, you will not have a problem. Now the question is whether the events can still go wrong, right? Someone would have added a AAA and thereafter, because NHB is a regulator, National Housing Bank is a regulator, and DHFL comes under NHB. NHB does audit. They could not find anything wrong until it got busted, right? There were international investors were there who were not, but who had their own independent due diligence. They also failed. So, end of the day, one cannot point out only that just because someone is paying you, you will not do the right thing. That's my view. The difference is that whether you want to do a right thing or wrong thing is the function of the independent person. So, our independent director, Rama Vijparkar or someone, their reputation is significantly at stake. If they try to do wrong for a 20 lakh per annum and that company does seriously wrong, whether they have any reputation, their lifetime value will significantly go down later part.
You have to simply become Dhritarashtra. You don't have to do anything wrong. You have to just put a black cloth on your eyes.
It's a view. I'm not even saying that. The problem is for the people who have been part of Satyam for some time, the key people, they struggled later to get their caliber jobs. So it takes time. It has a reputation risk in the socials market. So I would not totally say that because of this is a cause and therefore is an effect. That's because company is paying you, you lose your independence. I would not say it's a cause and effect. That's all my view is.
Correct. You are right in saying, but yeah, it requires a lot of guts and spine to stand against someone who is paying you. I mean, that is the highest level of ideal level of professional ethics that one should actually exhibit.
Regulators help you out. Ideally, that's why the amount of liability on directors, why they keep so much liability on directors is because of this. Why they keep liability on insolvency professionals is because of this reason. While the professional people are not happy with so much of regulatory governance on the profession, but the reasons are because of this, that for you to be independent, I need to put so much of controls on you.
For independent directors, insurance also is taken by the company only. The company pays it. I used to negotiate these insurance policies. They take a good 5 crore cover, and that becomes part of the condition for appointment, that
Yeah.
I need a 5 crore cover before you appoint me in case any reputation risk happens to me.
Insurance
So,
does not cover your knowing of doing wrong things. In the insurance covers only for the things of unknown things.
That is called DNO policy, I think. Director and
Mm.
officers policy, DNO policy.
Yeah.
In fact, I actually said no to an assignment. So there was this company which was doing a buyback, listed company. Okay. So it came to me in September, first week, 10th of September, gave me a draft certificate and said that this is on the basis of unaudited financials, March 21. I said, boss, by 10th of September, for sure your accounts are audited because you are having KPMG and all. So yes, they said yes. He sent me the audited financials. But he said, when you issue the report today, you write that this is on the basis of unaudited. I said that that is not possible. If you want a certificate, that can be on a situation where the date is not, the audited financials are not been, and there was a difference between cash, between debt as on the date of, as per the audited and unaudited. He said nothing doing. If you want this assignment, you do. Otherwise, I will go to someone else. I said, best case, we have a Udin generation 60 days window. So we can do it to a date which is before the audited thing. But he said, no, I want today's date and I want it on the unaudited financials because my numbers have been circulated. In that case, I said no, because of course, it really is completely, you can't really justify that. How many of you would have actually taken a different view? Or is there any method where I could have justified this? Because I said no to money. That is a major no in life.
Fully agree with your thoughts, sir.
Yes. Because otherwise it's a major challenge. So that is what it is. Yeah, so common intangibles, trust in management, employees, supply chain. So we talked about Facebook, Amazon, Alphabet. These intangible assets now account for 90% of the index's total assets. So how prevalent and essential intangibles have become to survival and growth, and hence this is one area where we can see intangible represents 16.9% of Microsoft's total assets, 2.7% of Apple's thing as per an analysis of their 10K. This reflects in part. So Microsoft have actually acquired all the more number of companies. So this becomes a part of their acquired goodwill. You can recognize goodwill. You cannot acquire recognize self-generated goodwill. You can only recognize acquired goodwill, and hence, since Microsoft has done a lot of acquisitions, now hence what you have to get into is you have to grab these varying treatments of internally developed versus acquired intangibles. How are valuations adjustments done? How do you integrate difference in accounting intangibles in the algorithms for automated trading and all? These are challenges which are there internationally. So there are a lot of mistakes in this thing. So these things can keep happening. So yeah. Different methods: relief from royalty, with and without method, replacement cost method. So here again, it can be MP excess earning method, meme method as they call it, or you can have a real option pricing. So on various methods, you can value intangibles. So thank you so much for the session. We can connect over LinkedIn, and I have a YouTube channel also where I sometimes keep talking about various issues. So I've got some 70,000 subscribers there and 30,000 on LinkedIn. And yeah, we can be in touch there. Any questions before we wind up?
Sir, I have a query.
Yeah.
Just give me 1 second. When there is any inquiry for valuation of sweat, okay,
Yeah.
and the personnel to whom 1 second, I'm a sound madbedi. So in this case, how do we value the set of say 4 person okay, who are not into technical or IP person. Okay, say for example, CS or CFO or any such operational person and not as such the techie team. Like there is no and I'm not playing the role of a company secretary here, wherein it is permitted, not permitted. That is not my role. Here, my role is to value the sweat.
Yes, yes, yes.
So can you just throw some
So the
light
same
on-
with and without method can be applied. It's very, very difficult. So I recently got an assignment. I was not able to do justice to that. So then I declined that. How do you actually quantify, in case of a techie, as you rightly said, the code that they develop is what is the lifeline of that company.
Yes.
But in case of people like the CFO, the CS, how do you justify the sweat equity that is issued to them? Because they are merely compliance professionals in a way.
Okay.
And they can be far more easily replaced than a techie who is instrumental to development of that product from the core.
Okay.
This is a practical challenge. I really don't have an answer to this because the theory, the academic theory says with and without method. But how do you justify that, especially in case of the assignment that I got was in the case of listed company? Then I said that was even SEBI and all will be involved. Let us decline this assignment.
In fact, in this case, the ROC of this particular place where the company's registered office there is very active, and he's very enthused in asking the valuer to come in person and explain his
Acha.
valuation.
Oh my God.
He happens to be the CA also. So he's very enthusiastic in questioning the valuer to understand that,
Then
the
this makes
report
the
is
task all
justified.
the more onerous.
Yeah, and that too, there are a team of 4. So even if we are successful in, as a group, we can make with or without. But with each individual of 4, in a team of 4, how can you make with or without, or whatever you get, how can you, distribute between the 4?
Absolutely. There could be different methods as I think as I speak that you could maybe, do a survey with potential stakeholders that while investing in this company, how important is Mr. Arvind to be as the CFO in your mind? And then maybe on that basis, based on that feedback, you can do an allocation of that combined value between these 4 people, that on a scale of 1 to 5, how much is Mr. Arvind important and how much is Ms. Ramya important, and like that, you can do a hierarchy and accordingly allocate the value. There is a method to that. Whether that method is right or wrong, very difficult to justify.
Whether replacement cost can be the best bet, then just see their market value and how much the company was paying.
Very difficult to say. I mean, in today's market, as a CFO, I run this CA job portal. My wife and me, we look at that. 50 lakhs someone is drawing today with an offer letter. They get a 40% hike. They are at 70, and during the notice period, they show that 70 lakh rupees offered to someone else, and they get another 40% hike on that. So from 50 to 98, it happens overnight. Means in a span of 2 interviews. Okay. So market value is the thing here.
I get it. Vijaya? On behalf of friends, it's already 9:25. It's our honor that Mr. Anurag had accepted our invitation to attend our session. 1 second.
Yes, ma'am.
Can you share the screen?
Yes, ma'am.
On behalf of Bangalore Valuers Association, we would like to show our gratitude by offering this memento to our today's speaker, Mr. Anurag. This will be couriered to you, Mr. Anurag.
Okay, thank you so much.
On behalf of Bangalore Valuers Association, one new member has joined our group, Mr. A.C. Rao. I request Mr. Shiv Prasad to say a few words about this new member who has joined.
Good morning, dear friends, dear DVA members. I got the privilege of introducing Sri Alekha Sharon Rao and next MD of Bank of Maharashtra to our group. He is an MSc Physics graduate in the MBA, registered valuer, and an insolvency professional. He has got a rich experience in banking, spanning over 3 decades plus of experience in State Bank of India, where he served as a chief general manager. And later he was elevated to the post of managing director in the Bank of Maharashtra. He has got a very good exposure in credit areas and general banking. I am very much honored to introduce Mr. Rao to our group. And I request all our members also to introduce such members, allied members to the group so that our credibility will increase, our reputation will increase, and their rich knowledge will be experienced will be shared by them with us. And we'll also be educated with their knowledge.
Absolutely.
I thank BVA for giving me an opportunity to introduce you all.
On behalf of Bangalore Valuers Association, now I request Mr. Prakash Kukreja to formally extend vote of thanks for today's speaker.
1 minute, madam. I think
Sorry.
Mr. Rao wants to
Yeah,
convey
please.
his thoughts.
Yeah, please.
Raoji.
Good morning, all. At the outset, Mr. Anurag, thanks a lot for such a very enlightening session. And
Yeah.
thanks to Mr. Siva Prasad for introducing to me. Having a journey in the banking for 38 years and having spent most of my time in treasury and also in the credit, it was always, valuation was always we used to rely upon the valuation done by the valuers. As Mr. Anurag has already opened up the things, how the valuation is done and how the so many examples with the so many rationales he has given. Actually, to understand that, after just my superannuation, I completed this insolvency exam. Then any kind of insolvency exam, when we just completed, it was a mere cakewalk. But when I just wanted to know the nitty-gritty of the valuation on which so much of haircuts are decided, while in the bank's boardroom, we were just, looking at the figures, what is the fair value, what is the liquidation value, and how to just take up the, sometimes in the videocon, we have to accept it at 95% haircut. To understand this conundrum, I just wanted to be a registered valuer. With, I think I had to put a lot of time and energy for this, and thankfully I could get through. And I look forward for a better, my association and also dialogue with my fellow colleagues over here in the fraternity of the valuation industry. And it is really a very ticklish area, very interesting. I love this company. Thank you. And looking forward for a better association and better interaction. Thanks a lot. Thanks to the BVA. Thank you.
Thank you so much,
sir.
Raul sir, for your kind words. Thank you.
Thank you.
Over to you, Mr. Prakash.
Yeah, thank you so much, Shilpa, Vijay, for giving me this opportunity. So, big thank you to Anurag sir for such a wonderful session. I think the way you covered it, and actually those are all contemporary issues, and I'm sure all the members would have benefited from that. I really like the range of topics which you covered, like from startup, then you also challenged Ashwin Damodaran's beta numbers, and yeah, that was very interesting. And I really like the kind of coverage you had. So thank you so much. And also, I would like to thank all the BVA members because they actually kept the session very live by asking so many interesting questions. So thanks to all of them, and looking forward to such more sessions from you, Anurag sir. So thank you so much.
Thank
Yeah,
you.
back to you, Shilpa.
I've shared my phone number also in the chat box. If anyone has, we can discuss any professional issues that can come. The valuation tricky issues, there are so many of them. It's always good to discuss. Yeah.
I think brand valuation is one topic. Yeah. Sorry. Brand valuation, one topic which I think Anurag sir would be very, very relevant because given the times we are in right now, and you had a gist about it, but I think that could be one topic which you can look at more in detail.
Yeah, sure.
Just a suggestion. Yeah. Thank you.
Mr. Prakash himself is a veteran and experienced valuer. So we will be soon listening from you and we'll be approaching you for a separate session on a topic which is of interest for you.
Sure.
Thanks a lot, friends, for attending this session.
Before concluding, I thank Shilpa for arranging this session and talking to the speaker, and again Vijaya, okay, to like again she started with the speaker, okay, initially to take this session. Thank you, Shilpa. Thank you, Vidya, and thank you, everyone. Have a nice
All right. Thank you
weekend.
so much.
Happy weekend.
Bye.
Thank you.
90826252.
Vijay, you can end the session.